thank you for having me here. One advantage of being the last one, but one speaker, I suppose, now that Sitaram is arriving, is that much has been said. I want to focus, or at least it was suggested that I should focus on the merger issue, about which too much has been said. But I'd like to look at this from one particular kind of lens. Why does this government do what it does in different areas? Like, for example, when demonetization happened, why would a government want to take 85% of the currency in circulation out? And the difficulty is that when you try and look at the explanations which are offered, they're not very transparent and clear. So you, in some sense, have to begin to dig to understand what is the drive. One has been suggested that you want to create larger banks which can be easily handed over to the private sector, but that is a medium-term goal. What exactly is the agenda? The reason I think this becomes important is, for example, if you take demonetization, normally economists, at least when we were being trained many years back, there was the Tinbergen principle that if you have only one instrument, then you can have only one objective. But if you ask the question, why do you need demonetization? They said, well, it's going to get rid of black money, it's going to get rid of counterfeiting, it's going to get rid of terrorist financing, it's going to actually, you have about 10 objectives which are going to be served by this one instrument. So similarly, what is the instrument of consolidation of banks, of public sector banks, being used to achieve? Now, in fact, what Franco had mentioned was what the Narasimhan Committee had recommended, and which was pushed significantly under Chidambaram, was the idea that we need to consolidate public sector banks because, along with liberalization, which is over a period of time opening because of financial liberalization, the Indian financial system to competition from international entities, we must be able to create our own giants, because if we don't have our own giants, we would not be in a position to be able to stand up. So the idea was consolidation was essentially to create world-class, world-sized banks, so at least in some comparative sense. So to buttress that argument, you essentially suggested that first of all, there are significant economies of scale and economies of scope associated with banking, as it is, let us say, in the chemical industry, etc. That is, if you just expand size, you're going to get productivity increases, even though how you calculate productivity in the financial sector is an extremely controversial issue. But the whole idea was that you will get greater efficiency, increased productivity, and therefore consolidation is not merely going to create your own giants to be able to face competition internationally, but it's also going to actually provide for you, because of the existence of economies of scale and scope, the benefits which could come from being more efficient, being able to offer better quality services, and being more productive. Now, in fact, if we look at the empirical evidence globally, there is no evidence at all to actually establish that in areas like banking, generally in finance, but particularly in areas like banking, that there is any case that there exists significant economies of scale and scope. So much so that when the 2008 crisis came, the whole demand was because of the fact that too big to fail institutions become too difficult to handle in a situation when you're confronted with a tendency towards systemic failure. What we needed to do was to break down the big banks. And this was part of the way in which the government responded to the crisis. And in fact, the Federal Bank of Dallas, the US Federal Reserve of Dallas, basically said that, listen, the reason why monetary policy is not working here is because of the fact that we reduce interest rates in order to generate a recovery. But the reduction in interest rates, as is being argued in India today, this reduction of interest rates is not being passed on. It's not being passed on because of the fact that you have these large behemoths sitting there, which actually convert them into higher margins rather than actually allowing monetary policy to work itself through. So it's not merely that you didn't have any evidence of economies of scale and scope, but you also had evidence that the existence of large banks makes it difficult, to the extent that monetary policy can be effective, for its effectiveness to realize itself, for transmission of monetary policy to actually occur. So therefore, let us leave that aside. But is that, even if you say that, okay, there existed this argument, whether it's, which I'm suggesting has been proven wrong, is that the argument which is being used currently? If you look at the finance minister's statement at the point of time when she announced it, with the same degree of drama she attempted but didn't manage as demonetization was announced, the basic idea was, she said that this is something which we are doing in order to achieve the larger goal of stimulating a recovery, taking India to the $5 trillion economy status, etc. And the way in which this was going to be done, she argued, was essentially when you have bigger banks, you're going to be in a position to be able to offer larger volumes of credit, and these larger volumes of credit will come at lower rates of interest. In fact, she said that already in my stimulus package, which had been announced 1 week earlier, we had said that you're going to link bank lending rates to the repo rate. The repo rate is being reduced by the Reserve Bank of India now under government pressure, and that would soon get transmitted in the form of a lower rate of interest. So the idea was that the theory of growth that you have to get this economy to wherever, 5 trillion US or whatever it may be, is one in which credit is going to play the central role. Credit which goes to the private sector, because credit in this case does not go to the government, because the government wants to control its fiscal deficit to 3% of GDP or near thereabouts. So therefore the government is not going to borrow and spend, but credit is going to matter, which means that you are basically saying that my view of the trajectory of growth is I'm going to substitute tax and debt financed public spending with debt financed private spending, both in the form of consumption as well as investment. And the whole idea is bank consolidation, she was trying to argue, would result in an increase in the volume of credit and a reduction in the cost of credit. Now, is that true? Is this argument something which can be backed? Now, if you look at it, there is no reason why, if you put 3 banks together, that single merged entity should lend more than what those 3 banks, because you're talking about, bank lending occurs on the basis of a deposit base, on the basis of monetary policy, and on the basis of the amount of new money that the system has generated over a period of time, because you can create credit in all sorts of ways, using credit cards, for example. So there is already a certain ability on the basis of the deposit base and monetary policy instruments in the state of the financial sector to create a certain amount of credit. If this is created by 3 banks, it's created by 3 banks. If it's created by 1 bank, obviously it's created by 1 bank. Just putting those 3 banks together is not going to give you a larger volume of credit. So it's not that the volume of credit is going to increase, but what is definitely now likely to increase, because the amount of single borrower credit that you can give from a consolidated bank is much bigger, because your single borrower exposure would be linked to your total deposit base. So if you have a larger deposit base because 3 banks have come together, whatever, Punjab National Bank, etc., with Punjab National Bank as our anchor, you're going to be in a position to offer larger size credit. Now, this is not necessarily a good thing, as we've seen. It's not necessarily a good thing, because we know, if you look at the first 12 and then subsequently the many cases which were referred by the RBI and to the IBC process, you actually had a situation where the first 12 corporate groups who had been referred to the IBC accounted for 25% of the total of the NPAs which prevailed at that point of time. So if you give large volumes of credit, the first problem could be that you'd actually be tying yourself with borrowers who, if they went bust, you're going to end up with very large defaults. And when you have large defaults, you don't want to recognize them as defaults. You want to restructure them, because it'll affect the solvency of the bank. So you keep this going for a long period of time, as they did. So basically, if you look at it from the point of view of what it does to credit, it doesn't increase the volume of credit. What it does is increases the size of credit. Does it help reduce interest rates? Does it make credit cheaper? Are you going to be able to now entice people with lower interest rates to actually borrow and spend, such that you can get a recovery and growth in a 5 trillion economy? No, there's no reason why it would not go down, because basically, if you enter an environment in which you have much larger institutions with less competition, there would be a tendency, as the Federal Reserve of Dallas, sort of recognized, there would be a tendency to actually try and get larger margins. You want larger spreads. So you don't. If the central bank reduces your cost of capital by reducing the policy rate or the repo rate, you're going to take that benefit and keep it for yourself. You're not actually immediately going to translate it into a lower lending rate. Now, secondly, it's if you're going to actually be lending in large volumes to individual borrowers who might end up defaulting, then obviously you could end up with a situation where you have losses to write off. So the way in which the world you are entering is a world in which, because you're going to have this tendency to give larger volumes of loans, your risk premium goes up. You actually will want to lend at a rate where you can cover the losses that you can make on defaults by getting a better spread on performing loans. So you would actually be in a world in which both of these are not going to be realized. You're going to be in a world in which you're going to move towards larger size lending, which of course is not a very positive thing, And two, you're going to get higher interest rates, not lower interest rates, so that even if we take that logic of us, obviously that's a logic which is just a created logic. It's not a logic which can be founded on the basis of any empirical evidence, just as much as consolidation leads to greater efficiency argument doesn't apply in the financial sector and banking. So is there anything else we can think of which is actually pushing this, pushing the system in this direction, the policy in this direction? Well, one thing which is pushing policy in this direction is, of course, is that if we look at where we are coming from, what we know is that in the period since 2003, there's been a huge transformation. There's been a huge transformation of banking in India. And that huge transformation of banking in India is that accompanied with a massive increase in liquidity in the system, we had a huge credit boom, and a huge credit boom in which now large volumes of credit were going to the corporate sector, to industrial lending by big corporate groups. And in that, you found that a very large share of the lending was going into projects which earlier the public sector banks did not lend very much to, and even today, the foreign banks do not lend very much to, which is the infrastructural sector. Now, why don't banks normally not lend to infrastructure? Because banks actually have got monies which are short-term in terms of their maturities, in which depositors want easy liquidity, they don't want too much credit risk and capital risk. So therefore, you don't want to lock up too much of your money in long gestation, high-risk projects which are illiquid. So therefore, you actually say that, listen, we need development financial institutions. We need public expenditure to actually build capital-intensive projects and infrastructure, steel industry, dams, roads, ports, civil aviation, etc. So you basically said that that's tax and debt finance state expenditure and specialized financial institutions, like the development financial institutions, supported by the Reserve Bank of India, which used to take its reserves and support them. It supported the publicly owned development financial institutions to provide large credit to the private corporate sector, because there is no long-term corporate bond market in India, in most developing countries, because savers are not willing to risk their money in long-term bonds beyond a point. Therefore, you need to find other ways to close the gap for long-term finance. Now, one of the things of liberalization is, having successfully to a certain extent closed that gap, we shut off that success. We shut off that success in a double way. First, of course, we shut it off by saying that, listen, we want to incentivize the private sector, so we are not going to tax too much. Our tax GDP ratio remains low and goes down, and therefore the state cannot spend, particularly because of the fact that we are shutting ourselves in a second way, which is we are saying that we are not going to have significant amount of deficit finance spending. We are not going to borrow it for 4.6% from the central bank, from the Reserve Bank of India. We are going to go to the open market and borrow it at 7.5 or 8% or whatever it may be, and we can't go more than 3% of GDP. So the state ties its own hands. It cannot spend, cannot actually take on the role of making these capital intensive investments. Two, the state decides that to create a level playing field, as the Narasimhan Committee recommended, you can't allow banks to compete with these specialized financial institutions getting doles from the budget and from the central bank reserves. So let's close down the development finance institutions. So you converted the IDBI into IDBI Bank, merged ICICI Bank, IFCI hardly exists, it's just a policy financial institution. So you close down your whole development financial architecture, excepting for a few policy mandated refinancing firms like NABARD, etc., or SIDBI. So then you're basically saying that, okay, how do we finance all this capital intensive investment, this infrastructure which we know is woefully inadequate to support this growth under liberalization, and now to convert us into a 5 trillion economy? Obviously, you have to find some other source, and the source they found was the public banking sector. Now, so the whole idea was you had to coax the private sector into borrowing and making these investments, because why would the private sector come to an area which is highly risky, which involves lumpy investment? So you say, don't put too much of your own capital. We'll find the capital for you, you invest, and we'll try and find ways in which we make it profitable for you. Now, the problem was that strategy did not work. Public sector was given, the private sector was given money, both through PPPs and directly. They made these investments, but they couldn't make it profitable for them. And therefore, you began to see these large defaults in areas like steel, in power, in roads, in ports, in civil aviation, etc. So therefore, you're now saying that, listen, you're in a mess. So we have to do two things. One, we have to clear this mess. So to clear the mess, one of course is that we have to try and move these firms, and I'm going to quickly end now, move these firms out of the straitjacket we put them in, which is we have to move them out of the PCA framework, the Prompt Corrective Action Framework, because if they are under PCA, then basically it would mean that they cannot lend. And we have to get them to lend because we don't have an alternative now. We don't have one market. We are not getting away from our financial reform, fiscal reform. So therefore, we need to get the banks once again to lend. That's where the whole idea of moving credit comes. So what you do is when you merge, what you're in essence doing is you've got whether you're in PCA or not depends upon what your net NPA ratio is. So when you merge, you get a weighted average net NPA. That is, the highest NPA comes down, the lowest NPA goes up, and you get merged NPA. So the first thing is you want to move all of these institutions into a level in which the NPA ratios are such that you can actually try and move them out of PCA. The second thing is you say, okay, we're just now not giving you 70,000 crores. Now 70,000 crores itself is not enough, but we'll give you 52,500 crores to make sure we can get you off the stool in which you're sitting where you cannot lend because you're overburdened with NPAs and because of the fact that we have straitjacketed you with all of these principles. So you're basically saying, first I'm trying to use consolidation and giving them this money to move them out into this from this situation. But the question is, have you resolved the fundamental problem? How do you know that when they now start, because of course now they can give bigger loans, if they can give bigger loans, they can lend to infrastructure, they can lend to capital intensive projects. You're going to force them because now you have control over fewer banks and you're going to control them very, very heavily. But how do you know that next time around you're not going to have another NPA crisis? You're bound to have another NPA crisis because the fundamental problem is not resolved of finding ways where the state can finance capital intensive activities and you have specialized financial institutions and if you can manage a bond market. So if you then have another financial crisis, then obviously as you're approaching it, you're not going to want to be stuck in the situation you're currently stuck in. So even as you see it coming, you'll want to get these banks off your hands. That's not going to be too difficult because already most public sector banks are in the 40 to 50% private ownership range. That is, gradual dilution of equity sales has already taken them from 40 to 50%. So you just you change the rules, find a strategic investor, do 26%, hand it over. Now, of course, which means that those banks will be managed by private sector rules, but at least they wouldn't do something. So it means that maybe you wouldn't have growth, maybe you wouldn't have infrastructure, but then maybe if there is going to be an NPA crisis, you can say this is a private crisis. We'll have the PFRDA bill, or you basically say that at that point of time you confront this crisis by actually saying, oh, we can't help it. We got to do exactly what was done in the United States, the United Kingdom, and in Europe in 2008. We actually saved these banks by putting in a large amount of money from the Treasury and the central bank. So you would have gone through this route in order to be able to get yourself to exactly where you went. So in essence, if you start asking the question, why do they do it? It's because they just don't care about the long-term consequences. They just want to make it appear that they got rid of black money, they got rid of terrorist financing, they got rid of counterfeiting, and they've actually got credit moving at extremely low rates, and therefore going to do a 5 trillion economy. Thank you.